Is renting a home really the same as throwing out money? When the topic of buying versus renting a house comes up, there is a big debate about which option makes the most sense financially. Both sides have great points, which makes the arguments not so white and black. A common thought process is, why would you pay rent to a landlord? You are throwing your money away and not building any equity. In reality, this is not completely true, and there are many financial reasons why renting could be better. Though historically owning has shown to be a better financial decision for most, we are going to see how renting can be better in some circumstances. In this video, we are going to break down the argument for both sides, and then we will also have a look at the economic analysis of both and see how a renter can possibly come out ahead of a homeowner. A common argument for renting is that you are just wasting your money. This is not the case. In exchange for your money, you are getting a shelter for you and your family. Yes, when renting, you may never see that money again, but when owning a home, you will end up dishing out lots of money that you will never see again as well. When you buy a house, you will be spending lots of money on taxes, interest payments, repairs, and more, and all of this ends up being money that you will not get back. The cost of home ownership is a lot higher than most people expect. At first glance, mortgage payments can seem low compared to the cost of rent. However, there are many costs that can run up as high as 50% of your mortgage payment. Some of the annual ongoing home ownership costs are mortgage interest payments, homeowner insurance, property taxes, utilities, flood insurance, mortgage insurance, maintenance and repairs, condo or homeowner association fees, and the investment opportunity costs, or in other words, the cost of foregoing investments due to having your money tied up. In order to determine whether it makes more financial sense to rent or buy, you'll need to compare the total cost you'll pay when renting to the total cost of home ownership. Let's take a look at two brothers who want to live in identical houses in the same neighborhood. Both brothers start off with $30,000 in the bank. Brother number one decides to buy his house for $400,000 and amortizes it over 25 years with an interest rate of 3%. While brother 2 decides to rent the same house next door for $1,700 a month. Let's first have a look at the expenses of the brother buying the house. The homeowner will have to pay 5% or $20,000 upfront as a down payment. He will also have to pay land transfer tax of $4,000, legal fees of $1,000, title insurance of $400, a home inspection of $400, and a home appraisal of $200. This gives the buyer a total upfront cost of $26,000. This eats up most of his $30,000 he started out with. The renter, on the other hand, only needs to pay first and last month's rent upfront, making his total upfront costs come up to $3,400. Now let's compare their monthly costs. The homeowner pays a mortgage payment of $1,892 a month. It's also generally a good idea to budget 1% of the home's value for repairs. That would come up to $333 a month. The homeowner would also have to pay property tax, which varies depending on the city you are living in, but we will take an average number for 1% a year for property tax. This also comes out to $333. We will assume that the utilities and Wi-Fi for both houses cancel out. Since the houses are identical, both brothers would have to pay the same cost. This gives us a monthly payment of $2,592 for the owner and $1,700 for the renter. As you can see, even though the renter does not get any equity, he pays $892 less every single month. The difference between the money a renter pays and the money the buyer pays is the opportunity cost of owning the house. The opportunity cost is defined as the loss of potential gain from other alternatives when one alternative is chosen. Assuming the renting brother is responsible, we will assume that he banks all of the money that he saves every month and invests it at a 6% return every year. Now let's fast forward 4 years to see how their net worths have changed. Brother 1, the owner, has acquired some equity in his house from paying the mortgage. Though a lot of his money went to paying off interest, his home has also appreciated at 3% every single year. His net worth has increased to $81,708. Brother 2, the renter, has been investing that extra $892 at 6% and has increased his net worth to about $78,000. After 4 years, the two brothers would have a fairly even net worth. If the homeowner were to sell the property at this point, he would have to pay hefty seller taxes, lawyer and realtor fees that would actually put him behind the brother who is renting. Because of the high fees from initially buying and selling, a common rule of thumb is to simply rent if you plan on keeping the place for less than 5 years. If we fast forward 25 years, the buyer has seen a 3% appreciation in his home value each year and has finally fully paid off his home. He now has an asset worth $812,000. Adjusting for inflation, his investment is actually worth $470,000. The brother who rented earned 6% on his investment, only earning himself $684,000. Adjusting for inflation, his net worth is $395,700. From this, you can see that renting does not necessarily mean you are throwing your money away. If you are disciplined, you can still increase your net worth. Now let's change the numbers up. Let's assume the renter wasn't so disciplined and skipped out on a few investment contributions. Let's say he only invested 50% of his money he saved from renting. In that case, the renting brother now only has a net worth of $342,000. Adjusting for inflation, this money is worth $197,000. The second scenario happens more often because it is a lot easier to skip putting money into your savings account than it is to skip paying the bank a rent payment. Now let's look at a third scenario where the homeowner's house still appreciates at 3% per year, but the renter earns a 7.5% return on investment instead of a 6% return. Now at the end of 25 years, the renter has a net worth of $871,000 and $504,000 after inflation. As you can see, the variables play a huge role in determining which option is the best, but it does go to show that a financially responsible renter can come out ahead. Thanks for watching to the end of the video, guys. I hope this gives you some insight into the argument of renting versus buying. Please subscribe to this channel if you haven't already subscribed before, and hit that bell icon so you can receive notifications whenever I post a video. Thanks for watching.